$7,500 a year, completely legal, turns into about $605,000 you never pay a single cent of tax on. And if you earn over $168,000 a year, you've been told you can't have the account that does it, the Roth IRA. That rule is real. The front door is locked. But there's a legal backdoor the IRS has openly acknowledged. It takes about 10 minutes a year, and almost nobody at our income uses it. I'm over that line too. I hit this exact wall. So I'll show you the 2 steps that get you in. And there's one mistake that quietly taxes the whole thing if you miss it. That one trips most people who try this, and it's invisible until the tax bill shows up. Stay for that part. Here's the math first, so you know this is real before I explain how. $7,500 a year. A normal market return, call it 7%, labeled so you can check me, left alone, that's about $307,000 in 20 years, $474,000 in 25. And in about 28 years, roughly age 60 if you're in your early 30s like me, around $605,000. Now, here's the part that makes it different from your brokerage account. Every dollar of that comes out tax-free. Not tax-deferred, tax-free. The same money sitting in a regular taxable brokerage account would owe tax on roughly $400,000 of growth on the way out. In this account, that $400,000 is yours, untouched, forever. That's the prize. Now let's talk about why you're locked out of it and how to get in anyway. The Roth IRA has an income limit on the front door. For a single filer, you get the full contribution under $153,000 of income, a partial amount up to $168,000, and at $168,000 you are completely shut out. Married filing jointly, that wall is $252,000. So you did the thing you were supposed to do. You earned more. And the reward was getting banned from the best retirement account in the country. Here's where most high earners stop. You were told high earners can't have a Roth. So you shrug and pour everything into your 401k and the taxable brokerage. That belief that the door is just closed is the trap. The rule has a legal exception, and it's been sitting there the whole time. I'm a cargo pilot, single filer. I'm over that line by a wide margin, so this isn't theory for me. It's the move I run every single year. So how is it legal to fund a Roth you're banned from? 2 steps. Step 1. You contribute to a traditional IRA, but a non-deductible one. Here's the crack in the wall. There is no income limit on a non-deductible contribution to a traditional IRA. None. Whatever you earn, you can put $7,500 in. The income limits the IRS built for the Roth front door, they forgot to close this side entrance. So that's step 1. The money goes into a traditional IRA after tax. No income test. Takes about 5 minutes online. Quick thing while we're at the first real payoff. If a tax-free 600 grand is new to you, that's the whole point of this channel. The specific legal moves high earners can use on a W-2. Subscribe so the next one finds you. Now, a traditional IRA isn't what we want long term. That money would get taxed when you pull it out. So here's the conversion that flips it tax-free. Step 2. You convert that traditional IRA into a Roth IRA. Normally a conversion is a taxable event, but you already paid tax on this money. It went in after tax. That's the non-deductible part. So there's no untaxed money to tax. The conversion itself comes through clean, tax-free. One timing detail that matters here. Do the conversion promptly, within a few days of the contribution, before the money earns anything. Because any gains it makes sitting in the traditional IRA before you convert are taxable. Contribute, convert, done. Don't let it marinate. That's the entire backdoor. In through the traditional IRA, across to the Roth. You report it once a year on one form, IRS Form 8606, and you're done. 10 minutes, give or take. Think about what just happened. You were banned from a Roth IRA, and you legally funded one anyway. Money that now grows to that $600,000 and comes out without a tax return ever touching it. And no, this is not the business owner solo 401k or the holding company version you see online. You don't need an entity, an LLC, or a side business. you need a salary and a brokerage login. This is the W-2 employees version of the move, the one the entrepreneurs got all the attention for. This, by the way, is layer 3 of the raise capture system I broke down in another video, the tax-advantaged accounts layer. And it's the account that comes right after your HSA. Max the HSA first, then run this. Now the part I promised, because this is where almost everyone who tries the backdoor gets quietly taxed, and they never see it coming. It's called the pro-rata rule. Here's the trigger, and it's specific. Have you ever rolled an old 401k into an IRA when you changed jobs? If you have any pre-tax money sitting in an IRA right now, this next part is the difference between a clean tax-free move and a surprise bill. Watch this closely. The backdoor is only clean if you hold $0 in pre-tax IRAs. That's traditional IRAs, SEP IRAs, simple IRAs, anything where the money went in before tax. Here's why it bites. The IRS doesn't let you cherry pick which dollars you convert. When you convert, it looks at all your IRA money together and taxes your conversion pro rata across the whole balance. Make it concrete. Say you have $50,000 sitting in an old pre-tax IRA from a job rollover. You add your new $7,500 and try to convert just that. The IRS sees $57,500 total, and only about 13% of it is your new after-tax money. So only about 13% of your conversion comes through tax-free. The other 87% gets taxed on a move you thought was free. That's the trap. It's the one rule that turns this into a tax bill, and most people who get burned never knew it existed. Here's the fix, and it's clean. Roll that existing pre-tax IRA money into your 401k first. Your employer 401k, or a solo 401k if you have one, because 401k balances do not count in the pro rata calculation. Only IRA balances do. So you move the pre-tax money out of the IRA world and into the 401k world. Now your traditional IRA is back to zero pre-tax dollars. And the backdoor runs completely clean. Order matters. Clear the pre-tax IRA into the 401k, then contribute the non-deductible $7,500, then convert. Same 2 steps as before, you just clear the runway first. Do that, and the whole thing is tax-free. Do it backwards, and you hand part of the win to the IRS. Real question for the comments, because it decides everything for your situation. Do you have an old pre-tax IRA sitting out there from a job rollover? Yes or no? That one balance is what tells you whether your backdoor is clean this year or whether you've got a roll into the 401k step first. Drop it below. I read them. So here's the whole thing in one line. You were never truly locked out of a Roth. You were locked out of the front door. The back door is legal. The IRS knows about it, and it's about 10 minutes a year. 2 steps. Non-deductible contribution, then convert. Clear any pre-tax IRA into your 401k first so the pro rata rule can't touch you. Report it on Form 8606. Repeat every year. And as always, this is education, not financial advice, so confirm your own situation with your CPA before you run it. If you want the order all of this goes in, which account fills first, how the backdoor slots in after the HSA, the whole sequence, that's exactly what crewbrief.co is built to run. Free 14-day trial, takes about 10 seconds, no card, and if your HSA isn't maxed yet, watch that video first. It's the account that comes before this one in the stack. I'll link it. That's the order. Run it clean, and a Roth you were banned from quietly becomes $600,000 the IRS never gets to touch.